A very good afternoon. You're watching the newsroom right here on ET Now. I am Ajay Sharma. It's a wonderful rally which is playing out in the markets. Sensex, Nifty, Bank Nifty, and even broader markets are performing well. It was a good handover from global markets, but domestic cues are also not bad. Flows continue, and commentary from North Block seem to be suggesting that the finance minister is already preparing a growth-oriented budget. That has got traders quite excited. Do not forget that the dollar index has also gone lower further, triggering flows into emerging markets, and India is benefiting from that. But what exactly should you be doing? We will be asking this question, how investors should be positioned, with a very big fund manager joining us on the show today. Prudential ICICI's life insurance CIO Manish Kumar is here. Manish, very good afternoon to you. Thank you so much for joining us. First of all, congratulations on your firm hitting 2 lakh crore in assets under management. It's a big feat. I was just reading up in a matter of 20 years the way company has grown. Before we talk to you about markets, how much CAGR do you think your company must have had in the last 20 years? Any idea?
Sorry, I didn't get the question. How much?
Yeah, I was asking the way your company has grown in the last 20 years. I was reading from 100 crore asset under management to 2 lakh crore now. How much compounded growth rate would the company have clocked in the last 20 years?
Oh, it is. It will be well into double digits, and since the starting base is very small, it will still be. It will be a very high number. But if you look at the last 15 years also, when I actually joined the company, which was at about 1,500 crores, from there also we have actually grown almost 140 times in the last 15 years. So it's a very big CAGR because the starting base is also small, but nevertheless it is a fantastic number that we have reached in a matter of 2 decades.
Well, that's correct, and even despite of that big number growth being achieved, insurance has just scratched the surface as far as the entire population is concerned. Barely metros, urban centers, there is so much of opportunity still as far as insurance is concerned. We'll talk about all of that. Also, wanted to understand how's the breakup now at 2 lakh crore asset under management. How much equities, how much debt are you managing?
So at 2 lakh crores, equities are comprising almost 45%, which is at about 90,000 crores. And debt is the balance at about 1,10,000 crores.
Excellent. So let me start a question with you on markets, but not on equities. You look at debt so closely, with over 1 lakh crore, 1.1 lakh crore in debt. What is your view on the way inflation numbers are pouring in, the way bond yields are? Are we in for lower interest rates for longer? Because that also indirectly is having an impact on revaluing the equity part. What's your view on interest rates?
So first of all, thank you very much for all the good things you have said about the company. Coming to the bond rates and the view on the inflation rates, I think going forward, as food inflation come down, we expect inflation rates to moderate. Having said that, we are still expecting core inflation to remain in the range of 5%. As far as bond yields are concerned, there is abundance of liquidity thanks to liquidity support by the government as well as RBI, whereas on the other hand, demand for credit has been rather weak. So in the short term, we expect bond yields to remain where they are today. That is, we expect it to remain sideways. If I have to take a little medium-term outlook, depending upon how growth picks up, which in turn translates into credit pickup, we may see a northward journey of the interest rates.
Right. You know, I was just reading somewhere that, one of the biggest NBFCs in India, HDFC Limited, in their recent fundraise, raised, paper at as low as 4.2%. Do you see this rates, for high quality companies being able to raise money at much cheaper rate, this translating into the economy, and this itself, low rate environment itself, in a way giving boost to corporate India and helping them cushion the hit from COVID and coming out gradually?
Certainly, Ajay, and that is something what has actually helped the economic environment the last few months as well. If you look at what has happened in some of the more stressed segments like real estate, for example, it was very badly hit in the June quarter. In the September quarter, and mostly in the month of September, we saw housing finance companies reporting very good growth in disbursements. And that momentum has actually accelerated thereafter. So be it buying of houses, be it buying of cars or two-wheelers, somewhere low interest rates have definitely acted as a momentum driver. And in a way, you are absolutely right that even if we go back in the period, say 2003 to 2008, one of the bigger drivers of the economy at that point in time was low interest rates. And the rates that we are seeing today, especially for consumers who are looking to, say, buy houses or cars, these are possibly the lowest rates that we have seen in the last 2 decades. And I am absolutely confident that at the margin, this will certainly act as a driver of demand and the economy in the medium term.
Manish, since we are talking today, one of the features of today's market is the way real estate stocks are rallying and flying away 10-12%. Not on stocks, but I just want to understand, real estate was a bad word, whether investing in real estate, commercial space or residential flats, or even real estate related stocks for last 4-5 years. Do you think there is merit in all of that changing now with low rates and work from home and a lot of people going to tier 2, tier 3 towns for good? Is there some demand, incremental demand coming in, and hence the fate for this space could be improving?
I would tend to believe so, Ajay. I think, as I was just saying, real estate actually has seen quite a bit of traction in the last few months. One of the reasons why it was not really a hot sector was not so much because of the nuances of this sector as it was about the balance sheets of some of these companies. However, in the last 2 years, some of these companies have actually paid a lot of attention to improving their balance sheets. And now, with improved balance sheets, if the offtake is also coming back to them, then actually you are seeing a combination of these two factors coming together. And there is quite a bit of a case to look at some of the better companies in the sector. And we are also there in the sector, although not in a very big way. We are playing this sector more through some of the leading housing finance companies, because that offers bigger players like us to actually navigate more easily. Having said that, we are also there in some of the leading companies in the real estate space.
Sure, Manish. In fact, I would like to take that argument further. Financials, private sector banks have navigated this space well. They raised a lot of money, showed up capital. But now even public sector banks are kind of doing successful QIP, which is quite nice to see. What are your thoughts on financial as a space which had shrunk a lot in representation on the index a couple of months back, and people are writing obituary about it, but now everybody wants to get back on the financials bandwagon?
So I think the compression in the financial space happened partly because of liquidity withdrawal and partly because of fears around what will happen to the asset quality of the overall portfolio. I think both the reasons were justified in a way at that point in time. But as we have seen that the Indian financial sector has really arrived in terms of the robustness and stability, and a lot of these banks actually managed to raise capital in the last 6 months, strengthen their balance sheet, and with a lot of support coming by way of measures from the government as well as RBI and abundance of liquidity, we also saw a revival in the economy. And as a consequence, the fears on asset quality turning very bad has actually is looking like being belied. This is not to say that they will not see higher slippages in the second half. Possibly the retail slippages will be somewhat higher in the second half than what we've seen so far, as banks will recognize them. But as we also know that most of the leading banks have made adequate provisions in the last 3 quarters, and therefore they are priced for that. So in a way, now that liquidity has made a comeback, the fears around asset quality have abated. What we are seeing today is merely a normalization of the valuations that got hit in the first 2 quarters of the current calendar year.
My last question to you, Manish, you've seen so many cycles in your 2.5 decades of being around in financial markets. One section of the market, participants are getting wary of valuations, looking at record highs every day. Others are saying next 2-3 years, earning cycle is upward and hence valuation will get adjusted. Even now, one could look at buying. Which side of the argument are you in? And where in the cycle do you see the Indian markets right now? Are we in medium cycle, early cycle, or how do you see things pan out from here?
A very interesting and very valid question. So let me give you our perspective on the current market levels and valuations. There was a time in the month of March when everybody was sounding extremely negative, and we were completely on the one side of the valuation curve. At current market levels, we feel the sentiments are exactly reverse of what was prevailing in March. Today, the consensus appears to be positive. Whosoever I talk to, he only tries to bring the good news to me, and nobody is fearful of the markets. So purely from a sentiment standpoint, there is a case for being somewhat cautious. From a valuation standpoint, if I look at next financial year earnings, given the fact that this is a year of disruption, are based on whatever we can visualize and see, and also looking at the consensus estimates, we are roughly trading at about 20 times next year earnings. And that is also based on the fact that we are expecting almost a 30% kind of earnings growth next year, maybe more than that. So on this reduced base, a 30% growth on which a 20 times multiple is certainly close to the higher range of the valuation band, and hence the need for caution. At the same time, I also wish to point out that US markets today are also at a record high in terms of market cap to GDP. They are at about 2 times, which is actually higher than where they were, say, even in 99. So in a way, there is plethora of liquidity, and therefore, because of this plethora of liquidity, I think the markets are likely to structurally settle at a somewhat higher multiples, even though it may not necessarily be 20 or 21 times. And therefore, based on these observations, my view is as follows. We believe that purely from a valuation and sentiment standpoint, we ought to be somewhat cautious at the current market levels. We need to invest in a calibrated fashion in a combination of both debt and equity. We should be prepared for some corrections in markets which can happen anytime the next 1 or 2 months, or a slightly longer phase of consolidation which may actually extend into the middle of next year. And yet, having said that, from a 3 to 5 year perspective, we remain positive on the equity markets.
Right. Right. All right, Manish, always
I hope I have answered your
chatting
question.
with you. Thanks so much for your time this afternoon as well. Time for a very short break. Right, absolutely. No, completely. I get your point. That was a very balanced view. Time for a very short break. More news and analysis on the other side. Don't go anywhere.